kind of respect to the people who crashed iron, actually, because it's a terribly flawed system.
Yeah,
It really
look,
is. And a properly functioning market will destroy things like that.
yeah,
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 so
yeah,
this
yeah,
is the free market doing what the free market should. And there's Marc Cuban coming out saying, "Oh, we need more regulation." I'm going, "Well, no, not this. We don't. We actually just need
I
the
know.
market to be
Yeah,
allowed to
yeah.
do what the market does. And if people
We're
like idiots like you lose money, well, frankly, you deserve it."
This week, we saw Titan Finance go from a total value locked of $2.3 billion and a value of 60 per token to absolute zero. The utility of this Titan token is that it was used to mint the Iron stablecoin. The Iron stablecoin was a fractional stablecoin, meaning 75% of its value was attributed to USDC that was locked in, but the other 25% was locked into this volatile Titan token. Now, arbitrageurs were supposed to come in and keep the price of iron at $1. If it lost its peg to the upside, they could come and bring supply into the market, either by selling their tokens or minting new ones. However, being the savvy people that they are, they actually recognised a huge opportunity here. They could in fact make more money by collapsing the price of it below the 75 cent guaranteed by USDC, and they could just pocket those gains. That's a much easier way to make money. Furthermore, there was a coding error that boils down to something as simple as a missing equals sign. This means that the total value of USDC is currently locked in a smart contract. Now, this has just been a brief overview, and Frances can explain it a hell of a lot better than me, so with that, I'll pass you over to her. Thanks guys, I'm Ian, this is Brokenomics, and enjoy. Hey guys, hey guys, welcome to Brokenomics. Ian here. Today I'm joined by friend of the channel, Frances Coppola, former banker, author, blogger, journalist, and operatic singer, to explain to us exactly what went down with the debacle of Titan and its stablecoin Iron. Frances, could you explain to us exactly what happened in this fiasco?
Well, the price of Titan crashed to zero, and Iron fell off its peg and was trading somewhere south of 70 cents. And some people made some free money, and a lot of other people were very shocked and bewildered and didn't know what had happened. So, but the problem is that really this was set up in the design of the whole thing right from the start. Now, the design of the Titan Iron stablecoin relationship kind of relied on a positive feedback loop. So Iron was partially collateralized by Titan. Titan was a tradable token, which partially relied upon its use as collateral for Iron to support its price. So the idea was that, people would buy Titan because it was useful for Iron, and that would raise its price, and then they'd go in and mint Iron, and there would be this nice feedback loop, and so the price of Titan would rise, people would make profits, and Iron would be a reliably pegged stablecoin, 75% collateralized by an actual stablecoin, USDC, which is regarded by most people as a safe dollar equivalent, and with Titan as the swing asset that helped to keep it on its peg. So they would people would mint Iron and burn Titan, and then if they redeemed Iron, then Titan would be minted. That's how it works. So when you redeemed an Iron token, you would receive 75 cents USDC and 25 cents Titan, in effect, assuming all other things being equal. And that redemption rate, that one USD value for each Iron token, was fixed. The white paper for Iron actually calls it a soft peg, but when you've got a fixed redemption rate like that, it's not. It's a hard one. It's an actual obligation that they can't get out of, and it is actually automated. So if you redeem an Iron token, you get 75 cents USDC and the dollar equivalent of 25 cents of Titan. And similarly, if you mint Iron, you have to contribute 75 cents USDC and the dollar equivalent of 25 cents Titan. That's how it works. There's also a relationship between Titan's price and the price of Iron. I mean, this is, I think, should be obvious, really, that as Titan's price rises, so the value of the collateral in the Iron pool rises, and that tends to push the price of Iron upwards, tends to push it off its peg upwards. That encourages people to come in and mint more Iron, which burns some Titan. But Titan is a tradable token, so you can raise its price by, trading it as well. So this could set up a positive feedback loop whereby the price of Titan rises, speculators make profit, and iron is reliably pegged. Even though more of it is being minted, it still holds its peg. And the white paper appears to assume that there would never be much of a downside movement. The price of Titan wouldn't crash to zero, wouldn't crash very much because of its use as collateral for minting iron. In fact, the possibility that Titan's price might drop substantially, even to zero, and drag down with it the price of iron was a feature of the whole design. What they don't seem to have allowed for is the possibility of speculative attack, despite the fact that the design allows for people to claim free money if they can force down the price of iron below 75 cents. And that's because iron is 75% collateralized with USDC, which is regarded as a safe US dollar equivalent. So if you can get iron to fall below 75 cents, then you can redeem your iron for 75 cents and make a profit. In my view, that was the purpose of what is, to me, evidently a speculative attack on this system.
So,
go on.
So actually what happened was that the very arbitrageurs they were relying on to keep it pegged, it was that kind of mentality that actually caused the whole system to come crashing down. Absolutely.
They expected the arbitrageurs to, when they saw the price crashing, to come back in, buy it and prop it up again, and thereby push up not only the price of Titan, but also get iron back onto its peg. And in fact, they did the opposite. They said, oh, look, if we can push it down further, we can claim some free money, right? And in fact, the post-mortem published by Iron Finance suggests that this was actually triggered by a group of whales who started selling Titan. In other words, that this wasn't just an opportunistic, oh, we can get in here, force it down further and claim some free money. It was actually, if we can attack this system, we can set up a death spiral for Titan, and by doing that, crash iron and claim free money. And I think that's what was going on.
Wow. Okay.
Now, if I talk a little bit about this enterprise encoder, because this is brilliant, because it's remarkable that they've claimed that this was an error, because as far as I can see, this has saved their bacon. Apparently, there was a clause in the code that basically said if the price of Titan fell to zero, then people couldn't claim their USDC. And they seem to have been rushing to fix this so that people could actually claim their USDC. But I find this a bit odd, because it looks to me as if somebody actually put a little bit of a failsafe in there just in case it did fall to zero. Or it may just have been they put it in just because. But it has actually meant that the loss of USDC from the pool actually did stop.
I mean, yeah, the enterprise encoder certainly sounds a bit more plausible than the incompetent coder. I think, in terms of forgetting this little equal sign that meant the entire mechanism essentially failed the way it was, in the case of going to zero.
Failed the way it was supposed to, yes, absolutely.
Yeah.
I mean, I must emphasize, this is in the design. It's a design flaw. There was no way this could be corrected by clever coding. This is a design flaw. The whole market mechanism essentially expects arbitrageurs to want iron to be on its peg, and doesn't allow for the possibility that they might actually have very good reasons for wanting it off its peg.
Yeah.
Because this possibility of making $3 is kind of built into the design. It's just a badly flawed mechanism.
Yeah.
I found it interesting that there have been some calls from, one whale in particular, and I do slightly wonder about his motive, Marc Cuban, for more regulation of stablecoins because of the crash of Titan, and more importantly, the collapse of iron, because it's interestingly happened only about a day or two after he'd written a fairly fulsome blog post saying Titan was marvelous and he was investing in it. So it was a little bit embarrassing for him.
Yeah, quite the turnaround there.
But I don't know, but for me, it was a badly flawed design. It deserved to crash and burn. and respect actually to the arbitrageurs who brought it down, because actually a well-functioning market will destroy things like this, and that is as it should be. Yeah. We shouldn't have to rely on regulation for something that is as badly designed as this was, simply to crash and burn. And if people lost money because they invested in something as stupid as this, well, I'm actually not very sympathetic. I don't think they should be bailed out unless they are genuinely kind of totally naive retail investors. But people like Marc Cuban, absolutely not.
Do you think he's angling for a bailout?
I don't think he's angling for a bailout so much as regulation to kind of save him the consequences of his own stupidity. I don't think that's the way it seems to me. It's
greed. I'd argue it's greed rather than stupidity. Like when you saw the sort of APR numbers, coming up there.
Yeah,
people just start to salivate almost when they look at them.
Oh, absolutely! It's the I can make money out of this, and you don't consider the downside, and you don't do the due diligence of actually going looking at this thing and saying, is this something that I think is sound and something I'd want to invest in? And actually, I've looked at things like this before, and I wouldn't touch any of them with a barge pole, because this kind of self-collateralization thing doesn't work. Iron was a fractionally reserved stablecoin. Now that immediately should raise red flags for anybody in crypto, because fractional reserve instantly means instability. We know that. Yeah. Iron was a fractional reserve stablecoin, furthermore, that was relying on its collateral value to keep it on its peg.
Yeah.
And yet 25% of its collateral was made up of a highly volatile token issued by the same issuers. So it wasn't even an independent coin. It was.
Yeah, sorry. No, go on, Frances.
It wasn't even an independent coin. They were relying on this kind of reverse pump mechanism, whereby you when you minted iron, you burned Titan, and when you redeemed iron, you burned Titan, you minted Titan thing, to manage the supply on both sides, and therefore keep the prices roughly in line with each other. And the kind of take over the world thing that all these things have in mind, really, we can print more and more and more of these things and their price will remain stable, was all about speculation on Titan will pull up the price of iron, enabling people to mint more iron without forcing it off its peg, right? That was the whole kind of behavioral explanation of what they were trying to do here. But they just ignored the whole downside risk, as far as I can tell. Yeah. Apart from this one clause in the code, which did at least protect them if the Titan's price actually reached zero. So for me, it deserved to crash and burn, and all things like this deserve to crash and burn. Fractional reserving stablecoins does not work, and neither does self-collateralization with these kind of circular things. They don't work. If you're going to collateralize something, do it properly.
Fair point. And I think on the sort of investor side, retail or venture capitalists, or whatever way you want to look at it, institutional, I should say, not venture capitalists, institutional and retail side, like they were, like Marc Cuban, seduced by these huge yields. But I think possibly a lot of them didn't actually recognize the fact that a large amount of that yield was purely speculative in nature, in terms of it wasn't just that they were earning interest and transaction fees. What they were actually benefiting from was the price of the token going up.
Yeah, absolutely. But the whole thing depended on the price of the token going up.
Yeah. And it is kind of, it doesn't really wash with me that these guys never actually considered the fact that the price might go down. I know from reading, I'll drop a link in the description. There's a very good Medium article I read on the subject, that this is actually the fourth project they've had that has failed. And in the midst of sort of trying to clear up this mess, they were actually trying to shill their next couple of projects.
Oh, what?
Yeah. Whilst blaming the investors for crashing the price.
Well, it certainly wasn't the investors' fault. I mean, actually, I personally think the arbitrageurs who crashed this did a public service. Respect to them.
Yeah. Because they didn't do it for free.
Well, okay, so they were doing it to make money. But I'm sorry, if you design something that makes it possible for people to claim free money, you can't really blame them for claiming it.
Oh yeah. Absolutely. Like, I think this is like one of those things that flip, all of a sudden some arbitrageur was looking at this and going, hang on, this isn't really a good thing for me to arbitrage because I actually have to take on too much risk to do it. Like there's 25% of this that is unstable and I can't just execute and get out of it in one transaction. I have to hold it for too long and take up too much risk. And then they flipped that around in their mind, saw the other side of it and turned what was a problem into an opportunity. So in a way, it's a beautiful example of lateral thinking on their part.
It's also an example of what arbitrageurs do. No, they do this stuff professionally. I would expect arbitrageurs to see this kind of opportunity and seize it. Yeah. I don't think it's reasonable to expect them not to say, oh, well, we can see this opportunity, but we're not going to take it. And I don't think it's reasonable to expect them not to see it either. They're professionals. This is what they do.
Yeah.
And, you know, they're crashing, arbitrageurs that crash entire countries doing this. I mean, this is a tiny little DeFi project. Of course, they can crash this one too. I mean, it may not be the same arbitrageurs, but it's the same kind of thinking that says, I can see a profit opportunity. No, so you can crash an entire country's currency, force it off its peg, force it into hyperinflation, which is we had a form of Titan actually experienced what in a fiat currency would be hyperinflation, whereby to meet a fixed currency external currency obligation, which was the one USD value par redemption for iron, they had to print more and more and more and more Titans. They ended up printing trillions of them. And when that happens in a fiat currency, we call it hyperinflation. That's exactly how the Weimar Republic crashed and burned. It's the same thing where the Reichsbank had to print more and more and more marks to enable Germany to meet its foreign currency and gold obligations. It's exactly the same. You'd think people would learn from history. We know how this ended. We know how this works. Yeah. This is the failure of an FX peg under a circumstance where you have external fixed currency obligations. That does not end well.
No, and certainly like a word of warning to people, like, you know, these guys are going to be up with 3-4 more projects probably in the next 6 months to a year. Like I'll drop their names in a little intro or outro exactly who's involved in it, but just like red flag these guys, like do not touch them with a barge pole or get involved in anything they do. You know, a classic example of a business failing, well, the people who ran it actually probably found a way to get out with some money.
Or possibly even pulled the rug themselves.
Yeah, could well have.
We don't know because I don't know anything about these people, but the whole DeFi space is full of that kind of rug pulling. It's possible that they did it themselves or their mates did or whatever. But so I would caveat that slightly and say that, you know, there are professional investors out there who can protect themselves. And if some of them want to get involved in something like this, then the warning is always do the due diligence. And if you see an opportunity like this, take it.
100%.
No, we want the professional people out there who can exploit opportunities like this to do that, because we want these things to go to, you know, we want these things to crash and burn. Yeah, for sure. Although I'd put good money on the fact that another project with pretty much exactly as the same as this, maybe with an equal sign added into the code, will be turning up in the next couple of months. No doubt, and Arbitrageurs could bring that one down too. It'll be fun. I should look out for it. No, seriously, as long as you are designing things to create opportunities for people to make free money, then people will seize those opportunities. They really, really need to think about what they're trying to do here. And you know, with all, you know, sort of due respect, they're not reinventing finance. We've been around this so many times. Know what arbitrageurs do. There's no reason to suppose that this time is different. Okay, well, is that everything? Have we got everything covered there, Frances? Or is there anything else? I think so. Well, thank you so much for coming on. So nice to chat to you again. Friend of the channel, Frances Coppola. Thanks a million. Absolutely brilliant content, fantastic explanation. Cheers, and we will see you guys soon. Pleasure. Bye. Bye. As the price of Titan tanked, more and more and more of it was printed or minted. We saw this in Germany in the... Let's leave it for a fucking hour or two, bring the dog out for a fucking walk, right? And then try explaining to Steph. Because that's what I find, because within an hour, I was like, right.